Hello and welcome to the Tax Roundup. Inside this month, we're going to cover all the important issues for accountants and advisors across the month of May. We're going to take a look, of course, at the federal budget and the key tax initiatives that came out of those announcements. We'll also take a look at a really interesting case that deals with the tax treatment of proceeds from an insurance payout. And in this case, it dealt with the insurance proceeds coming out of a natural disaster, which, of course, as we know, there's quite a few of those in Australia in the last financial year. But first up, Michael Carruthers is going to take you through the ATO's new client identification system. Now, this framework seeks to verify that the client is actually who they say they are, and the accountant will be required to do that. Across to you, Michael.
Well, the ATO has released a discussion paper that is really aimed at tax agents and BAS agents, and it's all about verifying the identity of your clients. Now, this issue has become more and more important over the years as we've seen incidences of identity theft and fraud increasing across the community. And what we're hearing is a number of stories of where accounting practices are actually being targeted in order to obtain things like TFNs from clients so that they can be used in identity theft. So the ATO is a little bit concerned in this area, and it is an area where the ATO wants to make sure that accounting practices, in particular tax agents, have pretty robust systems in place to make sure that they know exactly who they are dealing with when they're doing things on behalf of their clients or assisting their clients. At the moment, this paper basically sets out some minimum standards that the ATO expects that tax practitioners and their firms will be adhering to when it comes to identifying clients and their identity. But at this stage, it's not compulsory. What the ATO is hoping is that across the course of this year, that there'll be further consultation in this area and that these standards will be developed to the point where they do become basically compulsory for tax agents who are dealing with the ATO on behalf of clients. Now, again, as we say, this is a minimum set of standards. So this is kind of the bare minimum that the ATO expects pretty much accounting firms to already be hitting when it comes to verifying client identities. The way that the ATO really is structuring this at the moment is to say, look, if you take on new clients or you have new representatives for existing clients, so that could be key people of company clients, for example, or you have any concerns at all that the person you're dealing with might not be who they say they are, then you should be making sure you work through a process to verify the identity of that individual. And the ATO then uses this discussion paper to set out the ways that you might practically go about doing that. And that could be, for example, visually citing identifying documents that match to the person that you are dealing with. Now, there are a number of other steps that the ATO expects to be taken and some practical guidance around how you might implement and use something like this within your firm. Now, as I say, it's not compulsory at the moment, but the expectation is that these are the sorts of things that firms should already be doing. As things, hopefully, we get to the end of a few lodgement deadlines over the next little while, now would be a good time to start thinking about whether your firm and the processes within your firm hit that minimum expectation from the ATO. And if they don't, start to implement some of these features of the discussion paper to assist in making sure that you know exactly who it is that you're dealing with. So we're expecting to see more developments with this over time. The ATO says that before something becomes compulsory, there probably will be a transitional period to help people get into, I guess, the habits that the ATO is suggesting that we should be using. And there is likely to be further consultation with the tax profession as well. So this probably isn't the final version of what we're going to see, but we're certainly getting some way to seeing something that is something that will be mandated and compulsory for tax practitioners.
Now across to Matthew on those budget announcements.
Now, if you've had a chance to read the budget, which was released a couple of weeks ago, you'll notice that it's really aimed and targeted at trying to help an economy through its recovery. To be fair, many of the tax measures announced weren't really transformative or structural style tax reforms, but were really aimed at extending current concessions or really improving the current tax system that we've got. On the business front, the key here is probably some extensions to current concessions that are aimed at encouraging capital investments. The current instant asset write-off, or really the temporary full expensing measures, allows businesses with a group turnover of less than $5 billion to claim an immediate deduction on the purchases of their depreciating assets. This measure was originally due to expire on the 30th of June 2022. However, the budget has proposed to extend this for one more year. Now, not everyone wants an immediate write-off on their depreciating assets. This might depend on, for example, someone's marginal tax rates. The current rules do allow you to opt out of the temporary full expensing measures. Presumably, the extension to these measures will still allow you to opt out. And if the opt-out measures are implemented or extended in its current form, it's probably important to just keep in mind that if you're dealing with a small business entity, that is an entity that has an aggregated turnover of less than $10 million, then to get away from the immediate deduction, you'll need to opt out of both the simplified depreciation rules and the temporary full expensing measures itself. Now, interacting quite well with the temporary full expensing measures are the company loss carryback measures, which have also been extended as well. In a nutshell, the company loss carryback rules essentially allow a company with an aggregated turnover also of less than $5 billion to carry back their losses against previous year's tax profits, going as far back as the 2019 income year. Now, this measure was originally intended to expire at the end of the 2022 income year. However, this has also been extended for one more year to end in tandem with the temporary full expensing measures. On the individual front, the real excitement here are the announced changes to the residency test, or proposed changes to the residency test. If you've dealt with residency issues before, you'll probably know that this is a notoriously difficult area to navigate. The idea here is to move away from the more subjective factors-based analysis towards a bright line, primary, 183 days or more presence in Australia test to work out whether someone is a resident or not. Now, if someone is here for less than 183 days, then the rules as intended should allow you to default to a secondary test. But this secondary test is intended to still be based on objective specific criteria. It's still early and we haven't seen any legislation or draft legislation as of yet. So it's a bit early to see how these rules will actually end up. Having said that, if you have a client base of individuals that are a bit more globally mobile, it's probably worth keeping your eye on this area for any new developments. Now, for employers and employees, the budget did announce some changes to the employee share scheme rules, which are really intended to make them maybe a bit more attractive. The way the current rules work is that under a deferred employee share scheme, you could get a taxing point when someone leaves their job. This is problematic because leaving someone's job doesn't necessarily mean that there are no restrictions preventing that employee from either selling their shares or exercising their options, maybe to even pay for the ESS tax bill in the first place. Now, the idea is to remove this taxing point so that the real ESS taxing point is more closely aligned to when an employee can realise some value from their shares or options issued under an ESS. Now, finally, just to recap on some of the big ticket items. If you have a client that carries on a business and is looking to make some capital investments on depreciating assets in the future, it's probably worthwhile thinking as to whether you can make these investments within the timeframes of the temporary full expensing measures, which proposed to end under the budget by 30th of June 2023. On the other hand, if you have a client base that has individuals that are a bit more globally mobile, it's probably worthwhile keeping your eye out on any developments around changes to the residency rules. In particular, keeping an eye out and watching for any new legislation or draft legislation when it gets released.
And now to Michael on that case dealing with the insurance payout.
There have been quite a few interesting cases in the last month or so. But the case that I want to bring to you this time is around a taxpayer who received some insurance proceeds relating to storm and flood damage sustained by their rental property. And this is the Descent case. I'm not sure if they pronounced that correctly or not, but basically dealt with an individual taxpayer who owned a rental property, and that rental property suffered some damage due to storms and flooding. Now, the taxpayer held some insurance relating to the property, and initially they received an insurance payment from the insurance company that was specifically aimed at compensating them for the loss of rental income. And the taxpayer disclosed that in the tax return, so that really wasn't a problem here. Later on though, the taxpayer received another settlement payment from the insurer. It was around $250,000. Now, the settlement deed, the documentation around this settlement payment didn't have a whole lot of detail in terms of what it related to. And the question here was really, was there a tax impact on the taxpayer from having received that payment? Now, what happened was that the taxpayer did end up incurring some expenditure to repair the damage sustained to the property. Over a couple of income years, they claimed deductions close to around $130,000 worth in terms of repairing that property. But they did not recognise any of that additional insurance payment in their tax return as assessable income. Now, the ATO undertook some sort of review or audit activities, I assume, because of the significant repair costs that were put through the client's tax return or the taxpayer's tax return. And the ATO noted that this insurance amount was not recognised at all for tax purposes. And the ATO basically went through the process of amending assessments and including that insurance in assessable income. And the matter then went to the tribunal to have a look at whether the ATO got this right or not. Now, what the tribunal kind of worked through was what we refer to as the assessable recoupment rules. These are rules that can cause an amount that you've received to be assessed on revenue account, even though it would not ordinarily be treated as ordinary income. And the way the rules tend to work is that if you have received an amount that basically represents a reimbursement or recoupment of some deductible expenses, then that amount becomes assessable to you. It basically offsets the deduction that you've claimed for that expense. Now, there's a few different ways those rules can be triggered, but in this case, the focus was on some quite specific wording in the legislation around insurance payments. Effectively, what the rules say is that if you receive a reimbursement or a recoupment of a loss or outgoing by way of insurance, as the taxpayer did in this case, then that can be included in your assessable income, where that loss or outgoing is able to be claimed as a tax deduction. Now, in this case, it was pretty clear that an amount had been received by way of insurance, so that bit was pretty straightforward. The tribunal then looked at the situation that, was this something that related to an expense that was claimed as a deduction? Now, the taxpayer had said that the money they received from the insurance company, they didn't directly go and spend that on anything that was deductible. The tribunal said that you don't need to show that. You don't need to show that the physical cash you've received from the insurance company has then been spent on the deductible repairs. It's enough to show that that compensation amount, that insurance amount, relates to an amount that you have claimed as a deduction. So the tribunal concluded that this insurance payment should therefore be included in assessable income under the assessable recoupment rules. That's fine to some extent, but there's a really big gap in the decision. The decision is very, very brief, and it really only looks at a couple of key features of those rules, but the thing that's a little bit confusing is what's not said and what's not addressed in this decision, because there do seem to be some pretty significant gaps here. For example, the tribunal basically just concluded that the entire $250,000 amount was assessable, even though the taxpayer had only spent around $130,000 on deductible repairs. The decision doesn't discuss at all how do you get that final answer. Yes, it seems clear that some amount should be assessable, but why would it be $250,000? It might be the right answer, but the decision just doesn't really explain how the tribunal reached that decision. The other thing is that there are a number of provisions within that subdivision that were simply not discussed at all. And it would have been really interesting to see whether discussion of that, if we'd worked through that in a methodical way, would have ended up with the same outcome. For example, is this amount to be taxed all in one income year, which would presumably mean a larger tax liability for the taxpayer than if we spread that deduction over the income years when the repairs were claimed as a deduction? There are certainly provisions within subdivision 20A that suggest that maybe that's how it should work, that you might actually spread deductions over a couple of years. Again, the decision just doesn't go there, it doesn't talk about it at all. So we'd left kind of with a bit of a question mark, a few holes in terms of how we get from kind of point A to point B. There's really a few gaps there. Now, a couple of things to take out of that are, if you do have clients who have suffered some loss or outgoing, that can be claimed as a deduction, whether that's repairs or something else, and they receive an amount of money that represents a recoupment or a reimbursement of that, it's very likely that they will have some sort of tax liability associated with it, or some sort of tax impact anyway. But we then need to be a little bit more methodical and thorough when it comes to determining how much should be assessed and when that amount should be included in assessable income. And I'm not sure that this case actually helps answer either of those two questions. So we will need to do a little bit more digging ourselves when we encounter clients with that situation. Now, this is a pretty common area. I mean, lots of clients have properties that are damaged by storm events, by fires, all sorts of things. Particularly over the last few years, we've had significant natural disaster events in Australia. This is an issue that lots of clients will have to face. So starting point is recognise that those insurance payments may well have a tax impact. We then need to really get stuck into the detail of what's been received, why it's been received, to then figure out the tax impact.
And that's the tax roundup for this month. If you're one of those advisors who are yet to sit or yet to pass the FASEA exam, just bear in mind that you only have a few opportunities left to actually sit that exam. If you sit after July, you have to pass the exam. You will not have another opportunity to pass under the current sitting schedule at the moment. If you need support to fast track your study, Knowledge Hop would love to talk to you about supporting you through that process. We have a full suite of programs that support accountants, advisors, stockbrokers and risk advisors really get through that exam. We'll take you through exactly what FASEA requires. Just give the Knowledge Hop team a call on 1800 800 232 or have a look at the website. The full suite is laid out there. We'll look forward to talking to you soon.